This is Dr. Phil Rosenkrantz again with Introduction to Retirement Planning, Part 2. On our title slide, you'll see that we're in the second of 4 parts. Let's go to slide number 2. And the objective of this part is we're going to determine our total capital that we're going to need in order to fund our retirement. And our approach is going to be to, first of all, estimate what we think our living expenses are going to be. We're going to determine a rate of growth on our investments after we retire, and then using those 2 pieces of information, we will back into a total capital amount that we're going to need to have when we retire so that we will be able to generate the revenue to live off of in the style we're going to be accustomed to. Let's go to slide number 3 and talk about determining what our retirement living expenses will be. Well, the strategy we're going to use is to estimate our living expenses first off using our current lifestyle and expenses and adjusting for future plans and goals, and we're going to do it using today's dollar amounts. So you need to make a list of what all your expenses are that you have now and that you think you'll have in the future. Add to that other goals and plans, let's say for travel or for gifts or for charity or for the kinds of cars you want to drive, etc., and any other housing expenses, and we're going to get a dollar amount that would reflect the lifestyle you want to retire at, but in today's dollars. Now, you might want to consider paying off your house or whatever your living situation is. A lot of the experts say that paying off your house seems to create a better mental state at retirement. I won't go into that. You can read about it in that book if you want. But anyway, after you do that, we're going to now adjust for inflation over the next N period of years. So let's say you're going to retire in N years, and let's say you assume an inflation rate of 3 or 3.5%. Then we're going to multiply that amount that you think you're going to need today by the appropriate F over P factor and get a future amount. Then we're going to multiply by a tax multiplier to come up with what we think we're going to need in future dollars to live off of. So let's go through some of that. Let's go to slide number 4. If you come up with a retirement income need of $40,000 or less, then we're going to multiply by a tax multiplier of 1.1. And you can see that for these different stages, we're going to have different tax multipliers. Above $100,000, we're going to use a tax multiplier of 1.3. The effect of getting some of your retirement income from a pension will increase that, or if you're working part-time, so we're going to add either 0.05 or 0.10 to those factors depending on whether or not you're getting your income from a pension or from part-time work. And so we're taking taxes into account on a very elementary level. Let's go to slide number 5 and look at inflation. And 3 or 3.5% would be a pretty reasonable historical average for inflation. And if you want to adjust that up or down based on your feelings about the future or whether or not you think you can decrease your expenses, your costs over time, you're welcome to. But that's a personal number that you're going to use. Let's go to slide number 6. Let's say, for example, that you've determined after inflation that when you retire, you're going to need $100,000 a year to live off of, and you're not going to have a pension. Well, multiply by the one factor for taxes, the tax multiplier of 1.25, and you're going to need $125,000 to start with at retirement. if part of that $100,000 is going to come from a pension, you're going to need a little bit more because your taxes will be higher. 1.3 times 100,000 gives you 130,000. So I know I'm moving a little fast, but if you need to go back over this, go ahead. Let's move to slide number 7. I'm going to digress for a moment and mention that it's generally accepted that when you retire, your tax liability is going to go down. And the reason is going to be that a lot of your income after retirement is not ordinary income that's taxed at the really high rates that you experienced during your working life. Let me give you an example here of why living off of investments has a lot less tax liability. Suppose you own 10 investments. They're each worth $50,000 for a total of $500,000. So let's say you have $500,000 invested in 10 investments. Let's say that each one of those goes up 10% in value over the course of a year. So they go from $50,000 to $55,000 each. That's great. Now your investments are worth $550,000. That's an increase in your assets of $50,000. So that's great. You've now made $50,000 over that year. But here's the difference. If you made $50,000 of ordinary income, like on a job, you'd be taxed on that $50,000. But here's what we do as investors. Let's say you want to pull that $50,000 out to live on. Well, what you could do is you could sell one of those investments, and that would be one of those $50,000 original investments, which is now worth $55,000. You could sell it. Well, your taxable gain on that was the difference between what you paid for it and what you sold it for. So you paid $50,000 for it. You got $55,000 when you sold it. So your gain is $5,000. You only have to pay tax on the $5,000, even though you ended up with $55,000 in cash. Well, you see what happened there? You've still got some of your capital gains invested in your other investments. And so this is what happens when you live off investments. You put yourself in a lot lower tax bracket. Let's go to slide number 8. Now, our total investment return when we retire is really a composite of the return we're getting on our investment plus what we're going to be losing to inflation. If we take this equation and we adjust it a little bit, the return on the capital invested is our real return, and it's the total investment return, that's what we're making on our money, minus the inflation rate. And if we illustrate that with a couple of examples, suppose you expect 3% inflation, but you expect to get 8% on your investments after retirement, then you would figure a 5% return on your capital. For example 2, suppose you are a little more optimistic about inflation, you use 2%, but you think you're going to get 11% on your investment return, then 11 minus 2 is 9%. That's what we would use as a return on our capital invested. So let's go to slide number 9 and see what that means with our examples. So we're going to divide our estimated living allowance when we retire by this return on capital invested, and that will give us how much we're going to need to have upon retirement in order to fund our retirement. And so in example 1, if we use $125,000, which we had talked about before, and we use our example 1 retirement percents, then 8 minus 3 is the 5%. That would we divide that into 125,000, and that's $2.5 million we would need to have in order to generate $125,000 a year that we could live off of and pay our taxes. But this would also be enough money so that as inflation increases our living expenses, we can increase our retirement income to keep up with inflation. And then that would go on and on and on until we die. Now, when we die, we would then leave the investment that we in our capital, we would leave that to whoever we want to leave it to. But this approach assumes that we would be living for a long time. Now, if you wanted to spend your capital, you could live on less, but then if you run out of money before you die, then you're destitute. So we're not taking that approach here. Example number 2, you can see that if we expect to have a higher return on our capital invested of, say, 9%, then we only need $1,388,000 plus at time of retirement. So let's go to slide number 10. In other words, if you expect to get an 8% return on your retirement investments and you're anticipating 3% inflation, you'd need $2.5 million in assets to maintain that lifestyle. If you expect 11% return and only 2% inflation, then you need much less, $1,388,000. Well, that's the end of part 2. In part 3, we're going to talk about saving strategy and look at how we can generate that amount of money. Thank you.